What happens when the United States walks into the bond market expecting investors to lend it billions of dollars, and the investors suddenly demand a much higher price? What if the real warning is not that America cannot borrow, but that it is becoming more expensive to convince investors to keep lending at the scale Washington needs? If you want the clearest explanation of what is happening behind the headlines, hit like, subscribe to the channel, and share this video with someone who thinks the bond market has nothing to do with everyday life. Because this story is not really about a spreadsheet in Washington. It is about the price of money, the cost of debt, and the pressure building underneath the American economy. The phrase Treasury auction failed sounds dramatic, but there is an important distinction. The United States did not miss a debt payment. The Treasury did not walk away from an auction without raising money. What traders care about is something more subtle. How much investors demanded before they were willing to absorb the debt, how strong the bidding was, and whether the Treasury had to accept a higher yield than the market expected. A weak auction can therefore be a warning without being a default. And right now that warning matters because long-term Treasury yields are sitting at unusually high levels. On August 14th, a 30-year Treasury auction produced a yield around 5.22%, the highest level reported for that maturity since 2001. At the same time, the 30-year yield has remained around 5.2%, even after the Treasury announced larger buybacks designed to improve liquidity in the long end of the market. Seoul Economic Daily. Reuters reported on August 24th that Treasury Secretary Scott Bessent intends to keep the regular auction schedule while increasing long-term buybacks beginning in September. Reuters. In other words, Washington is trying to make the bond market function more smoothly at the same time that investors are demanding historically high compensation for holding very long-dated government debt. That is the part Wall Street cannot simply ignore. A Treasury auction is supposed to be one of the most routine events in global finance. The government announces the amount and maturity of debt it wants to sell. Dealers and investors submit bids. The auction clears. Securities change hands. The Treasury gets cash. For decades, this process has been treated as almost mechanical because U.S. government debt sits at the center of the world's financial system. But the size of the system has changed. America's national debt has now moved beyond the $40 trillion threshold, while the Treasury market itself has grown enormously. That means the government is not dealing with a one-time financing problem. It is constantly refinancing old debt while issuing new debt to cover current deficits. Every time a Treasury security matures, the government has to find buyers for the replacement financing. Every time the deficit grows, more securities have to be sold. That creates a simple but powerful question. How much debt can the market absorb before investors start demanding a significantly higher return? There is no magic number. A government bond market does not suddenly reach a point where buyers disappear forever. Instead, price does the work. If investors are less enthusiastic, yields rise until the securities become attractive enough to buy. That means a weak auction does not necessarily mean no one wants Treasury bonds. It can mean investors want a better deal. And that better deal is expensive for the borrower. Think of it like this. If a government can borrow at 3%, its interest bill is one thing. If it has to refinance large amounts of debt at 5%, the arithmetic changes dramatically. The higher rate does not hit every dollar of existing debt instantly, because older bonds continue paying their original coupons until maturity. But as those bonds mature and are replaced, the new market rate gradually works its way into the government's interest expense. This is why today's auction matters, even if the Treasury successfully sells every security it offers. The danger is not an empty room. The danger is a room full of investors who say, "We will lend you the money, but only if you pay us more." That is a completely different kind of pressure, and it is arriving at a difficult moment. The United States is already carrying a massive debt load. The federal government is running large deficits, and investors are watching inflation, economic growth, trade policy, military spending, and the Federal Reserve at the same time. Each factor affects the return investors demand on long-term bonds. The market is therefore asking two questions simultaneously. First, will the American economy remain strong enough to support the debt? Second, will the supply of new government borrowing keep growing faster than investor demand? If the answer to the second question becomes uncomfortable, yields can stay high even when inflation falls. That is one reason the current situation is more complicated than simply saying the Fed will cut rates and everything will be fine. The Federal Reserve controls the short-term policy rate, but the market determines Treasury yields across the curve. The Fed can influence financial conditions, but it does not dictate the exact yield investors require on a 10-year or 30-year bond. Those longer-term yields reflect expectations about inflation, growth, government borrowing, risk, and the amount of debt investors must absorb. And there's another important development happening in the background. The Treasury itself has started taking steps to support liquidity. in the long end of the market. The department announced that it would at least double the size of certain buyback operations beginning in September, focusing on longer-dated securities. Reuters reported that the move is intended to improve market liquidity, while market participants have debated whether these operations can have a lasting effect on yields, U.S. Department of the Treasury. That matters because buybacks are not the same thing as eliminating the deficit. They can help market functioning. They can change the supply and demand balance for particular securities. They can make trading easier, but they do not erase the government's underlying need to finance its obligations. And this is where the story gets bigger. The Treasury can manage the plumbing of the bond market. It cannot permanently escape the arithmetic of debt. If spending remains higher than revenue, the government needs financing. If debt keeps growing, refinancing needs keep growing. If investors demand higher yields, interest costs rise. If interest costs rise, the deficit can become larger. And if the deficit becomes larger, the Treasury needs to issue more debt. That is the feedback loop investors are watching. It does not mean collapse is inevitable. It does not mean the dollar is about to disappear. It does not mean America is suddenly unable to borrow. It means the cost of maintaining the system is becoming more important. And that is a much more serious story than the word failed suggests. At this point, you may be wondering why a Treasury auction should matter to anyone outside a trading room. The answer is simple. Treasury yields sit underneath a huge part of the American financial system. The 10-year Treasury is a major reference point for mortgage rates. It influences corporate borrowing costs. It affects municipal financing. It changes the return investors expect from other assets. When government bonds offer higher yields, companies often have to offer more to attract buyers as well. So when long-term Treasury yields remain high, the impact spreads. A family looking for a mortgage sees it. A company refinancing debt sees it. A city issuing bonds for infrastructure sees it. An investor deciding between a government bond and a corporate bond sees it. Even a person who has never bought a Treasury security can feel the effect through the broader cost of credit. And that is why this auction is worth watching. The headline is not that America failed to pay its bills. The headline is that the market may be becoming less willing to accept the old assumption that enormous amounts of new government debt can always be absorbed cheaply. That assumption is being tested. Take a look at the long end of the Treasury curve. A 30-year yield above 5% is psychologically important because it changes the conversation about what investors consider a normal long-term return. When the yield reached roughly 5.22% in the August 14th auction, the market was effectively saying that holding American debt for 3 decades required a return that would have seemed extremely high during the ultra-low rate era. Seoul Economic Daily. That does not automatically mean investors distrust the United States. It may mean they distrust inflation. It may mean they expect larger deficits. It may mean they expect more Treasury supply. It may mean they want compensation for locking money away for 30 years. Or it may be a combination of all four. This distinction matters because a bond market can become stressed without anyone believing the United States will default. If the bond market suddenly feels less mysterious, help this video travel a little farther. Tap like, subscribe for more clear market breakdowns, and share it with one person who usually skips financial news. The numbers are technical, but what they mean for ordinary borrowers is surprisingly simple. Investors can believe the government will pay every dollar it owes and still demand higher yields. Why? Because default risk is only one part of the calculation. Inflation risk matters, duration risk matters, opportunity cost matters, supply matters, the future path of interest rates matters. If an investor buys a 30-year bond yielding 5.2% and inflation remains unexpectedly high, the real return can be much less attractive than it appeared when the purchase was made. That investor may therefore demand a larger yield today as compensation. This is one reason long-term yields can remain elevated even when short-term economic data looks relatively calm. The bond market is always looking forward, and right now it is looking at a government that needs to finance an enormous amount of debt, while the cost of that financing is already elevated. There is another pressure that deserves attention: competition for investor money. The government is not the only borrower in the market. Large technology companies, banks, utilities, industrial firms, and other corporations also issue debt. The artificial intelligence investment boom has created especially large financing needs across parts of the corporate sector. When companies issue bonds offering attractive yields, they compete for some of the same institutional capital that might otherwise buy treasuries. That does not mean corporations are replacing government bonds as the world's safest asset. They are not. But investors still have portfolios to manage. A pension fund has a target return. An insurance company has liabilities. An asset manager compares risk and reward across securities. If treasury yields are high enough, government debt becomes extremely attractive. But if corporate bonds offer a meaningful additional spread, some capital can move toward those securities. The result is a competition for dollars. And when the Treasury needs to sell huge amounts of debt at the same time that companies are raising huge amounts of money, the price of attracting investors becomes more important. This is where the auction data becomes useful. Professional investors do not look at one number. They look at the entire pattern. They watch the bid-to-cover ratio, which compares the amount of bids submitted with the amount of debt actually sold. They watch the share purchased by indirect bidders, a category that includes many large institutional and overseas buyers. They watch the share taken by primary dealers. And they watch the tail, which measures the difference between the expected yield before the auction and the yield at which the auction actually clears. No single metric proves that the Treasury market is breaking. But several weak signals appearing together can tell a very different story. A soft bid-to-cover ratio suggests less aggressive demand. A smaller indirect allocation can suggest that some major buyers are being more selective. A larger dealer allocation can mean the dealer community had to absorb more of the issue. And a larger tail can show that the Treasury had to offer a higher yield than traders expected to get the debt sold. Put those signals together and you get something much more meaningful than a scary headline. You get information about the price the market is demanding. The next question is where foreign buyers fit into this. For years, the global financial system has relied heavily on demand for U.S. government debt. Central banks, sovereign institutions, pension funds, banks, insurers, and other international investors hold treasuries for different reasons. Some need dollar assets, some need liquidity, some need reserves, some simply want a highly rated government security. So when foreign demand changes, markets notice. But it is important not to exaggerate the story. A decline in the foreign share of an auction does not mean foreign governments have abandoned the dollar. It does not mean China, Japan, Europe, or other major holders are suddenly dumping every treasury they own. The reality is more complicated. Foreign investors can remain major buyers while becoming more price sensitive. They can buy shorter maturities instead of longer ones. They can hedge currency exposure differently. They can wait for higher yields before increasing purchases. That distinction is critical. The dollar's role in global finance does not disappear because one auction is weak. But if international investors consistently demand higher yields to absorb U.S. debt, the Treasury has to respond to that reality. And the response eventually reaches taxpayers. Suppose the government has to refinance a large block of debt at a higher average interest rate. The Treasury does not send a bill to households labeled bad auction. Instead, the additional interest expense becomes part of the federal budget. That means more money has to go towards servicing debt. Money that cannot simultaneously be used for something else without increasing taxes, reducing spending, or borrowing even more. This is the uncomfortable part of the equation. Interest is different from many other government expenses because it does not build a road, fund a school, or create a new program. It is the cost of financing obligations accumulated in the past. And when that cost grows large enough, it can begin competing with major parts of the budget. The United States can handle enormous interest payments because its economy is enormous and the dollar remains central to global finance. But can handle and costs nothing are not the same thing. Markets care about the direction. If debt is rising faster than the economy for a long time, and if interest costs are rising at the same time, investors can demand a larger term premium. That means they want additional compensation for holding longer dated bonds. And that can keep long-term yields elevated even if the central bank eventually cuts short-term rates. This is one of the biggest misunderstandings in the current debate. People often hear rate cuts and assume mortgage rates will immediately fall. Not necessarily. If the Fed lowers short-term rates while investors simultaneously demand a higher return on long-term treasuries because of inflation or fiscal concerns, mortgage rates may not fall nearly as much as expected. The long end can have a life of its own. That is why the 30-year treasury yield deserves so much attention right now. A 30-year bond forces investors to think about 3 decades of inflation, government borrowing, economic growth, political decisions, and monetary policy. Nobody can predict those things perfectly. So investors demand a premium for uncertainty, and when that premium rises, the cost of borrowing rises with it. Now, consider what happens if the market becomes convinced that Treasury supply will remain extremely large for years. Investors may start demanding higher yields before the government even increases issuance. The expectation itself can move the market. That is, because bond prices are forward-looking. If traders expect more supply tomorrow, they do not wait until tomorrow to adjust. They reposition today. This is one reason bond markets can move suddenly. A treasury auction can be the visible event, but the real decision may have been made hours or days earlier as traders adjusted positions ahead of the sale. That also explains why a weak auction can create a chain reaction. If An auction clears at a higher yield than expected. Other Treasury securities may sell off. Prices fall. Yields rise. Dealers reassess their inventories. Hedge funds adjust positions. Mortgage markets respond. Corporate bond spreads can move. The original auction may be over in minutes, but the information it revealed can affect markets for days. And this is where Treasury buybacks enter the picture again. The government's decision to increase long-term buybacks is an attempt to improve liquidity and manage parts of the Treasury market. It is a signal that officials are paying close attention to the stress at the long end. Reuters reported that the Treasury plans to maintain its regular debt auction schedule even while increasing these buybacks. That combination is important because it shows officials are trying to improve market conditions without simply reducing the government's borrowing program. Reuters. But the market still has to answer the bigger question: who will absorb the debt? Because the Treasury can buy back certain securities, but it still has a large financing requirement. It can change the maturity mix. It can lean more heavily on shorter-term bills. It can adjust buyback operations. It can communicate more clearly with dealers. But none of those actions eliminates the underlying deficit. That is why investors are watching fiscal policy as closely as monetary policy. If spending, revenues, and debt issuance remain on the same trajectory, the bond market may continue demanding a higher return. And if inflation remains sticky, the pressure becomes even stronger. Inflation is particularly important for long-term bonds because investors receive fixed payments over many years. If prices rise faster than expected, the purchasing power of those payments falls. That is why an inflation shock can push long-term yields higher even when the economy itself is not collapsing. Before we go further, leave a like if you want more videos that connect Wall Street moves to real-world costs. Subscribe if you want the next update when these Treasury auctions start telling a different story, and send this video to someone watching mortgage rates, stock prices, or retirement savings. One market can affect all three. Add energy prices, trade restrictions, geopolitical uncertainty, and large fiscal spending to the picture, and the market has plenty of reasons to demand a cushion. There is also a psychological factor. For more than a decade, investors became accustomed to extremely low interest rates and massive central bank support. Treasury yields spent long periods at levels that would have seemed strange in earlier decades. That era changed. Now investors are being forced to rethink what a normal price of money looks like. A 5% long-term government bond yield sounds ordinary compared with some historical periods. But after years of near zero rates, it feels enormous. And that change affects asset prices everywhere. Stocks are valued partly by discounting future earnings. When risk-free yields rise, those future earnings become less valuable in today's dollars. That is one reason high-growth companies can be especially sensitive to rising Treasury yields. Real estate is affected because mortgage financing becomes more expensive. Private equity is affected because leveraged deals become harder to finance. Small businesses are affected because lenders use market benchmarks when setting rates. Consumers are affected because credit costs remain elevated. So the Treasury market is not some isolated corner of finance. It is the foundation underneath a huge part of the economy. And that brings us back to the word failed. A more accurate description is that the market is showing signs of resistance to cheap government borrowing. That is less sensational than saying the United States cannot sell its debt. But it may actually be more important. A literal failed auction would be dramatic. A gradual repricing of government borrowing can be much more consequential because it can persist. If investors keep demanding higher yields, the government can continue borrowing. There is no immediate wall, but the cost accumulates year after year, refinancing after refinancing. And eventually, interest expense becomes a larger part of the fiscal conversation. This is why bond vigilantes have returned to the vocabulary of financial markets. The term describes investors who respond to fiscal deterioration by demanding higher yields. They are not literally organizing against the government. They are simply changing prices. But price changes can force political decisions. If the government wants to borrow more, the market can say yes at a higher rate. If policymakers want to keep borrowing costs down, they may have to convince investors that future deficits will be more manageable. That can mean spending restraint, it can mean higher revenue, it can mean faster economic growth, or some combination. The bond market does not care which political party wins the argument. It cares about the arithmetic, and arithmetic is becoming harder to ignore. There is, however, a reason not to panic. The United States still has enormous advantages. It has the world's largest economy. It issues debt in its own currency. The dollar remains deeply embedded in global trade and finance. Treasuries remain highly liquid. American financial markets remain among the deepest in the world. And there is still enormous demand for dollar-denominated assets. Those advantages make a sudden traditional sovereign debt crisis far less straightforward than the crisis stories you may see online. The risk is not that America suddenly becomes Greece overnight. The more realistic risk is a slow increase in the cost of capital, a world where the government can still borrow but has to pay more, a world where mortgage rates stay higher for longer, a world where companies pay more to refinance, a world where investors demand more compensation for long-term uncertainty, and a world where every additional percentage point of interest matters more because the debt base is so large. That is why the latest Treasury developments deserve attention, not because the United States has run out of buyers, not because the dollar is finished, not because a single auction proves an economic collapse, but because the market is sending a price signal, and price signals are often the earliest warnings in finance. The most important thing to watch now is not just whether the next auction technically succeeds. Watch the yield, watch the tail, watch bid to cover, watch indirect demand, watch dealer participation, watch the 10-year and 30-year yields after each major sale, and watch what happens when the Treasury increases or changes its buybacks. If demand improves and yields stabilize, the recent weakness may prove to be a temporary episode driven by positioning, supply, inflation expectations, or market volatility. But if auctions repeatedly require higher yields, if long-term rates stay near multi-year highs, and if investors continue demanding more compensation for absorbing government debt, then the message becomes harder to dismiss. It would mean the market is repricing the cost of America's fiscal path. And that is a story far bigger than one auction. The next few months may therefore be more important than the headline suggests. The Treasury is trying to support liquidity. The Federal Reserve is trying to balance inflation against growth. Investors are trying to decide what long-term government debt is worth. Companies are competing for capital. Households are waiting for borrowing costs to fall. And Washington still has to finance the gap between what it spends and what it collects. All of those forces meet in the bond market. That is why the Treasury auction matters. It is not just a government sale. It is a vote by investors on the price of America's future borrowing. And when that vote becomes more expensive, everyone eventually feels it. So the question is no longer simply whether the Treasury can sell the next batch of bonds. Of course it can. The bigger question is how much it will have to pay to do it. Because if the answer keeps rising, the consequences will not stay inside Wall Street. They will move into mortgages. They will move into business loans. They will move into government budgets. They will move into stock valuations. And eventually, they will move into the everyday cost of living. That is the real warning hidden inside a weak Treasury auction. The system did not break today, but the price of keeping it running may be changing. And in a debt market, this enormous, even a small change in price can become a very large number. So the next time you hear that Treasury yields moved a few basis points, remember what those numbers represent. They are not just lines on a financial screen. They are the market's estimate of what it costs America to borrow. And right now, that estimate is telling Washington something it cannot afford to ignore. The United States still has the world's most important bond market. But being the biggest borrower does not mean borrowing is free. Investors can remain loyal to treasuries and still demand higher compensation. They can trust the government to pay and still question how much debt it will need to issue in the future. That is the tension at the center of this story. America is not facing a simple buyers versus no buyers problem. It is facing a price problem. And price problems can quietly become budget problems, economic problems, and eventually political problems. If the next auctions come in stronger, this episode may fade. If they do not, investors may start asking a much harder question. What yield is high enough to make them comfortable with the amount of debt America plans to carry? That is the number worth watching. Because the bond market does not need to panic to send a warning. It only needs to charge more.